Did you know that if you invest just $5 a day, the price of your morning coffee, you could end up with over $1 million in 40 years, thanks to the magic of compound interest? It sounds unbelievable, but it's true. And the best part? You don't need to be a financial expert to make it happen. In today's video, I'm going to break down how this powerful wealth-building tool can turn small, everyday savings into a massive fortune. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Understanding compound interest is a game changer when it comes to reaching your financial goals. It's one of those basic yet powerful concepts in personal finance that can lead to significant wealth over time. But here's the catch. Many people overlook its potential simply because they don't understand how it works. So, let's dive into how compound interest actually operates. Simply put, it's when you earn interest, not just on your initial investment, but also on the interest that's been piling up over time. Think of it as a snowball effect for your money, where it keeps growing bigger and faster the longer it rolls. Now, there is a formula to calculate it, but I won't bore you with something that looks like a secret code for a spaceship launch. All you need to know is this. Your investment grows based on 4 key factors: the initial amount you invest, the interest rate that fuels growth, how often that interest is added, and how long your money stays invested. The more you optimize these factors, the more your money will grow. So in a nutshell, the more frequently your interest is calculated and added back to your investment, and the longer you let your money sit, the more your investment grows. That's the magic of compound interest. Your money doesn't just grow linearly, it grows exponentially as time goes on. So, why isn't everyone taking advantage of this simple yet powerful concept? I believe it boils down to 3 major reasons. Firstly, when it comes to investing and saving, many of us think we need a large sum to get started. We assume investing is a playground for the wealthy, or that we need to be experts to make good decisions. But the reality? You don't need a lot of money or a degree in finance to start building wealth. Anyone can do it, no matter how small the starting amount. Another common misconception is thinking we'll invest later, maybe when we're earning more, have cleared our debts, or reached a certain milestone. But the truth is, starting as early as possible is key. Time is the secret ingredient that makes compound interest so powerful, and the sooner you begin, the more time your money has to multiply. Finally, many people believe that achieving substantial returns requires making a large investment all at once. However, even modest, regular investments can grow remarkably over time. The real key to seeing significant returns is consistency and patience. By consistently making small contributions and allowing them to compound, you can achieve impressive growth. It's not about how much you invest initially, but about maintaining a steady investment routine and giving your money the time it needs to grow. The secret to making the most of compound interest is to start early and stay consistent. Even small adjustments, like a higher interest rate or more frequent compounding, can lead to impressive returns over time. For example, if you invest $1,000 at a 12% annual interest rate, compounded annually, you'd have about $1,120 after 1 year. But if you let that money grow for 20 years, it would balloon to approximately $9,600. Now let's kick it up a notch. If you add $100 every month to that initial investment, with a 12% annual interest rate compounded monthly, you'd end up with around $32,000 after 20 years. That's 32 times your original $1,000 investment thanks to consistent contributions. But here's where it gets really exciting. If you let that $32,000 sit for another 20 years with no additional contributions, at the same 12% annual interest rate compounded monthly, it would grow to approximately $260,000. That's many multiples of your original investment, demonstrating just how powerful compound interest can be as it works its magic over time. Now, circling back to our original point, by investing just $5 a day, the cost of your morning coffee, you could end up with over $1 million in 40 years. Here's how it works. By setting aside $5 each day, that's a total of $150 a month, or $1,800 a year. If you invest this amount into an account with an average annual return of 10%, the power of compound interest really takes over. Over 40 years, those contributions would have grown to over $1 million. It's a remarkable example of how even small, consistent investments can turn into a substantial fortune over time. While compound interest is incredibly powerful, there are several common mistakes people make that can hinder their progress. Let's explore these pitfalls and how to avoid them so you can fully harness the benefits of your investments. One of the biggest mistakes people make is withdrawing their investments prematurely. It's easy to feel tempted to cash out when faced with short-term needs or during market downturns, but this can significantly impact your long-term growth. Compound interest thrives on time, and the longer your money remains invested, the more it benefits from compounding. To avoid reducing your potential returns, set clear long-term financial goals and build up a separate emergency fund, which can help prevent you from dipping into your investments prematurely. Another common pitfall is not taking advantage of automatic contributions. Setting up automatic transfers from your bank to your investment account can be a game changer for maximizing compound interest. It ensures regular contributions without you having to think about them each month, which helps you build wealth consistently. Investing a large sum occasionally is great, but many people overlook the importance of consistency. Regular, smaller contributions often yield better results over time compared to sporadic large investments. Commit to a regular investment schedule, whether it's monthly or quarterly, and maintain discipline even during market downturns or financial stress. So what's the takeaway? The real magic of compound interest lies in starting early, staying consistent, and letting compound interest do its magic. By making consistent, small contributions, you set the stage for your investments to grow significantly over time. Don't put off building your wealth. Get started now and watch how those little investments grow into something impressive.